Have you ever dreamed of an extra $1,000 hitting your bank account every single month, like clockwork for the rest of your life? What if I told you it's not a dream, and it might be more achievable than you think? The secret isn't some crazy get-rich-quick scheme. It's a powerful time-tested strategy called dividend investing. And today I'm going to break down exactly how you could potentially turn a $100,000 portfolio into a lifelong stream of passive income. If financial freedom sounds good to you, do me a quick favor. Hit that subscribe button and ring the bell so you don't miss any of our future wealth-building videos. Let's get started. First, let's demystify dividends. Think of it like this. When you own a share of a company, you own a tiny piece of that business. When the business makes a profit, it can choose to share some of that profit with its owners. That's you. That shared profit is a dividend. It's real cash paid directly to you just for owning the stock. It's like getting paid to be an investor, on top of any potential growth in the stock's price. Unlike your day job, you don't have to clock in for this paycheck. Your money is doing the work for you. That's the beauty of passive income. So, how do we get to that magic number, $1,000 a month? That's $12,000 a year. To figure out how much you need to invest, we use a simple concept called dividend yield. The yield is the annual dividend per share divided by the stock's price, expressed as a percentage. For example, if a stock costs $100 and pays a $4 dividend per year, its yield is 4%. To get $12,000 a year, you can do some simple math. The goal is to build a portfolio with an average dividend yield of 12%. Do the math. $100,000 multiplied by 12% is $12,000 a year, or exactly $1,000 per month. Now finding a single safe stock that pays a 12% dividend year after year is extremely rare and often risky. So the strategy isn't about finding one unicorn stock. It's about building a diversified portfolio of different dividend-paying assets that, when combined, average out to that 12% yield. So, where do we find these high-yield opportunities? We need to look beyond just regular stocks. The first place to look is at real estate investment trusts, or REITs. REITs own or finance income-producing real estate. Think apartment buildings, shopping malls, or office towers. By law, they have to pay out at least 90% of their taxable income to shareholders as dividends. This often results in much higher yields than typical stocks. You get to be a landlord without the headaches of fixing leaky toilets. Another powerful tool is business development companies, or BDCs. These companies invest in small and mid-sized private businesses. They provide loans and take equity stakes, acting almost like a bank for growing companies. Like REITs, BDCs are required to distribute over 90% of their profits to investors, leading to attractive dividend yields, often in the high single or even double digits. And let's not forget about high-yield bond funds, or ETFs. These funds hold a basket of bonds from companies that might have a slightly lower credit rating, so they pay a higher interest rate to attract investors. While there's a bit more risk than government bonds, a well-managed fund spreads that risk across hundreds of different bonds, providing a steady stream of income. Now, let's put it all together. You wouldn't put all your eggs in one basket. You might allocate, say, 40% of your $100,000 into a few carefully selected REITs, averaging a 10% yield. Then, maybe another 40% into a couple of solid BDCs yielding around 13%. The remaining 20% could go into a high-yield bond ETF that pays 8%. When you blend these together, your portfolio's average yield gets very close to our 12% target. Remember, diversification is your best friend. It helps protect you if one investment temporarily underperforms. Of course, a crucial part of this strategy is reinvesting your dividends, especially in the beginning. This is the power of compounding. When you receive that $1,000 dividend, instead of spending it, you use it to buy more dividend-paying shares. Those new shares will then generate their own dividends. It creates a snowball effect, where your income stream and your portfolio grow faster and faster over time. It's the most powerful force in finance, and it's how you can turn that initial $100,000 into a much larger nest egg over the long run. Now, I have to be clear. This is not financial advice, and every investment carries risk. High yields can sometimes signal high risk. It's essential to do your own research. Look for companies with a long history of paying and even increasing their dividends. Check their balance sheets and make sure they have a sustainable business model. Don't just chase the highest yield you can find. A company that cuts its dividend can be a major setback. Slow, steady, and well-researched is the name of the game. The path to earning $1,000 a month from dividends is not a sprint, it's a marathon. It requires patience, discipline, and a solid strategy. But by building a diversified portfolio of high-quality, high-yield assets like REITs, BDCs, and other funds, the dream of a substantial monthly passive income can become a reality. It all starts with that first investment and the commitment to let your money work for you. So, what do you think? Is building a dividend portfolio something you're considering? Let me know your thoughts and any questions you have in the comments below. I love hearing from you all and reading your different perspectives. If you found this video helpful and want to learn more about building wealth and achieving financial freedom, please give this video a big thumbs up, share it with a friend, and most importantly, make sure you are subscribed to the channel so you don't miss what's coming next. Thanks for watching, and I'll see you in the next video.